So in the previous class, we have discussed about the modern technique method. In the modern technique method, I have told you what is the present value, net present value, and even we have discussed about a profitable index. Now today we are going to go with the main part, that is IRR, which is called as internal rate of return. So it is similar to that of ARR according to the traditional method. So here ARR was the one which is going to give us the profit percentage. Equally, the internal rate of return also is the same thing which gives us the profit percentage which a company is going to earn. But the ARR is the one which is followed according to the older concept, and IRR is the one which is going to follow the concept of the modern technique by taking the present values into the consideration. So, as earlier I have told you people that when we are going with the modern techniques method, it is assumed that our present value should be always the cash inflows should it's a condition. So cash flows should be always CFATD. This is I have told you n number of times. So CFATD means cash flows after tax plus depreciation. So why I'm specifically saying the plus depreciation, because as told earlier, without deducting a depreciation, the tax cannot be deducted, because the tax of any kind of a company, the tax payment is the last kind of a payment. Beyond that, we'll not have any other payments. So that is the reason if I have to deduct the tax, then I should rid of all other expenses. So in all other expenses, the depreciation is also one of the expenses. So that is the reason first I will deduct the depreciation, and then the last expenditure, that is the tax, I'm going to deduct. But what according to modern techniques is any kind of implicit cost is there, we can take into bank. So that is the reason the depreciation, which is not an explicit cost, means it is not a cost which is going out of my pocket. So that's why after deducting a tax, what I'll do, whatever I have deducted earlier, will I add it back. Is this clear? Whatever earlier I have deducted to deduct my tax, I am re-adding after deducting the tax. Hope it is clear. So that is the reason we first see it as cash flows after tax, but at the last we add a D for depreciation, which is added back at the end. So when we are following a modern techniques, this is to be followed must. Now, what is the condition? Is it every kind of a cash flows? We have to assume that it is before tax and the before depreciation, wherein I have to calculate again the depreciation, then I have to calculate a tax mean. Remember, if in the sum, if it is mentioned that annual cash flow is so and so, and beyond that, he didn't mention anything regarding the depreciation nor he regarding any kind of taxation, then I will assume that he has given me CFATD only. So that is the reason, again, I need not make any further calculations on it. So regarding that, I'll explain with one sum. So here the sum is given as investment. He gave it 12,000. And then he said cash inflows. He mentioned as a cash inflow as 4,000 annually. That means every year it is the same. So it is for how many years means for 5 years it seems. So he gave this much only information. He didn't mention me about what is the kind of a thing, like what I have to assume Is it a before tax or after depreciation? What it is? He didn't mention me any such kind of a thing. So when he didn't mention me any such kind of a thing, it doesn't require for me to take into consideration also. I need not take into consideration also. Simply that 4,000 I will assume that it is CF80D. So this is a note I'm giving here. Just have a look. As it is not clearly mentioned about cash inflow, whether it is before or after that. In such case, we should assume it is to be done with all calculations, and we should not do anything further. Therefore, and we are assuming our cash inflow of 4,000 to be CFATT. So directly I can do it. Now, this is a one more thing. He has given me the cash flows commonly for all the 5 years. It is 4,000 regularly expense. So when it is equal, rather than going a one after another, we can directly use annuity table and you can find it out. Now here I'll try to show you in both the ways. Now the first simplest using annuity. Annuity table at the rate of 19%. I'm going to take it up. So how much is at the rate of 19% is 3.058. So this one will be given in the time table, so the table which I have already provided to you people. So it is going to be given in the table, time value table you are going to have it, wherein the annuity, present value of annuity you have to check it. Present value of annuity, because we are doing the present value. So that's why if you are checking a prior discounting factors also, the present value table you are going to check. If you are checking the accumulator, then you are going to check present value and table for accumulated value. So this is at one point, and annuity table at the rate of 20%. I'm going to take it because yeah, one condition here it is whenever we are doing the IRR method, you need a proper solution. Means remember, you should get one present value to be positive value and one present value to be negative. If both are positive, if both are negative, the solution we cannot get it. Nor if we get it also, that is not a trustworthy solution, wherein we can't make any decision on it. So that's why if you want the genuinity of your decision to be appropriate and it is going to benefit in your future, then your present value should be one to be positive, one to be negative. It is must. So that is the reason here we are going to have a two things wherein you are going to check it. So fine. Now, here we have got. So what I'm going to do is use my IRR. I'm using it using a annuity table in a very simple and easy manner. Then he is giving me a directly the equal cash flows for all the 5 years. So simply what I'm going to do is 4,000 multiplied with 3.058. So when I'm going to do it, let me use my calculator. 4,000 into uh, 3.058. So I'm getting answer 12,232. So is equal to 12,232. So this is my present value. I'm not making net. When you are going to get a net present value, when you deduct your investment. Then one more we need a negative. So one more discounting factor I gave is what? At the rate of 20%. So these discounting factor I have done at 19%. 19%, wherein I'm getting a discounting value 4,000 at the annuity value I have multiplied. So I got my present value at this rate. Now let we go with the 20%, because if 20% also I'm not getting the negative value, then I have to search for one more digit or one more discounting factor I need to find out. So that's why we are going to check it out. Is it I'm getting at 20% a negative present value or not? I have to check it out. So let me check with again a calculation. So wherein I have multiplied again my 4,000 into 2.991. So I got is 11,964. 11,964 is the answer. I got my present value. So my investment is 12,000. So that means we got one present value to be positive and the second for present value to be a negative. How? If you want, you check it out. So here I said this is my present value. Now I'm going to deduct it with my investment. So minus investments, when we deduct it, which is 12,000. Therefore, my net present value, we are going to get is how much now? It is equal to 232. So I got this much. Now the same thing I'm going to find out with this one also. Again, here also I am minusing my investment, which is again a 12,000. So when I deducted with this 12,000, so I got my net present value to be 12,000 minus, let me minus again, is equal to, that is the 11,964 minus 12,000 if you do, you're going to get 36, that is minus 36. So here I got minus 36 as a value. So one, a positive NPV I got, the other one I got a negative NPV. So here, now I can use a formula and I can solve the things. IRR, it is a, remember, it is a condition that you want to solve it, then it is must that one should be positive value, one should be the negative value. Then only you are going to get the correct answer. So now let me apply in a formula. So what is the formula for this one is, now formula is equal to IRR. Formula is equal to positive discount factor you take down. Positive discount factor. Positive. Is it fine? Positive discount factor. Let me put it in fact. Positive discount factor plus, it should be underlined, positive discount factor positive present value minus investment. Positive present value minus investment divided by positive present value minus negative present value. Then here into negative discount factor minus positive discount factor. So this is the formula which you need to by heart it very carefully. This is a formula you need to understand very carefully and you should by heart it. So once again I will explain you. So IRR is equal to positive discount factor. So now I'm explaining along with applying in the formula. So positive discount factor means where you got your NPV, at which discounting factor you got a positive value. So we have got a 19 and a 20 discounting factor. So did you get a mean at a 19% you got a positive value of NPV, or did you get at a 20%? Means 232 positive value I'm getting at a 19%. So that one I'm going to plus here. That is 19 plus, again underline it. So here, what is the next one I said? Positive present value I have taught. Positive present value, total present value also is how much one? The positive present value is, we have got this one, 12,232. So that one I'm going to take. So 12,232 minus investment usage, which is 12,000. That divided by same. Again, I'm going to go with the same formula, positive present value minus negative present value. So how much is the negative? 11,964. That we will multiply with negative discounting factor is how much? 20 minus positive discounting factor is how much? 19. So this is how. Now I am going to apply here. Therefore, IRR is equal to, again we'll be using our calculator. So therefore, IRR is equal to 19, again plus. Now how much it is going to be? So how much it is going to be? 12,000 minus 12,232 is equal to 232 and divided by, I need to use my calculator again. So here, how much is that we have to minus now? 12,232 minus 11,964. So therefore I got 268. 268. Now into 1. Because 20 minus 19 is equal to 1. So I have got that one. Now 232 divided by 268. We need to divide it. So 232 divided by 268. When I do it, I got 0.865. So I can make it as 0.866. So here, therefore, my IRR is equal to IRR is equal to 19 plus 0.8665. Again, as usual, into 1. So therefore, my answer is equal to IRR is equal to 19.866 is the answer. So this much is the profits you are getting it. That is what here it is told. So this is one method now. So this is one method. Now I'm going to show you the same method, the same formula. You try it. If I'm going to give you, like as I said, the best and the easiest method when the cash inflows are equal for all the years. That is one method. Now I'm going to tell you the another one method wherein if you are not using an annuity method, but still you will get almost a similar answer by using the regular kind of present value discounting method also. So how it is? Now what you're going to do is, for cash flows we have got the cash flows, then what is the discount factor? Discount factor at the rate of 19%. I'm going to take. Then this is called the my present values. And then again cash flow, again my discounting factor at the rate of 20%. And then this is my present value. So I'm going to show you how without using this one, how we are going to, means if we are using for example, my cash flows are equal, the both way how we can solve it, that is what I'm going to show you. So first, cash flows for all the years it is worth 4,000. And discounting factor at the 19% for the first year it is 0.840. So the present value when I multiply it is 3360. Therefore, at the rate of cash flow first, this one also it is 4,000, whereas discounting factor is 0.833. When I multiply it, the answer is 333. Now, next year, 4,000, so 0.706. When I multiply, I got the answer 2824. Again, for this one also, it is 4,000. So my discounting factor 0.694. Then answer I got Then I multiplied 2776. Then again 4000. For every year I'm using a discounting factor. So 593. When I multiplied it, I got 2373. And here 4000 when I multiplied with the current discounting factor 0.579, I got the answer as 2316. Then again 4000 499. So when I multiplied it, I got 199. So 4000, so discounting factor 482. We will have a table for present values table. We are going to get the values from the present value table. So we have used, instead of using year by year, when the cash inflows are equal, you have to save your time. So to save your time, you use simply the annuity table. If inflows are not equal, they are unequal, they are changing frequently, then you don't have a choice. You have to go for using a discounting factor present value year-wise table. So that is the difference between this. So now when I have added this one, my present values are, for this one, it is getting me around 12,000. I said, no, almost we are going to, because here we are making a point changes now. Point as it is, we are changing a point. Previously, we got 32 last, 12,000 to 32. Now, 4 points less, we got 12,228. Why? Because there is a difference in taking off 4 points. That is the reason we have got like this. But it is almost equal whatever we have got it. So the answer is same. Now you can apply, I think. So simply you're going to go with what? You have got one positive, one you got a negative. So just to minus their investments. Now you apply in the formula. So here investment is 12,000, and here also we are going to minus with 12,000. So therefore your net present value here it is going to be 228, and here it is going to be 40 rupees. That is, sorry, negative minus 40 rupees. So now you got one positive and you got a negative. So for finding out, please, whatever I have given you, the formula here, looking into this one, now try to go for applying the same detail using the same figures. You have to just copy and paste it. So you will get the answer. So try to do the same thing and definitely you are going to get the answer. So you are going to get the same answer almost to the main. Whatever we got 19%, I think, so it will be the same 19%, but slight change. Here we got the answer, how much? 19.86. So here also somewhere you're going to come across 19 only, but there can be a change of 8.8 for after point. You may have a change in either it is going to be 7 or 9. It can be either the way. A slight change is going to be seen in this one. Or else the answer is going to be same. So please do try it. I've given you all the values. You can once try applying the same formula. You got a negative. So what is it we have to use? Positive present value minus investment. Positive present value minus negative present value. And here the negative discount factor minus positive discount factor. So please do try it. You're going to get the answer.